Hey everybody, what is up? Welcome back to Final Trade. I had several people ask me to start covering HASBRO quarterly results, conference calls, etc. And so this is going to be the first one of those. Now, if you've never experienced a corporate conference call before, it can sound a lot like a foreign language at first. There will be a lot of things you don't understand and a lot of concepts that are difficult to grasp. And really, it takes time. It takes a commitment to want to view conference calls from the same company for the course of years to really decipher everything that they talk about, because the management team at a company will often have its own way of doing things that is unique to that team at that company. And remember, accounting is not really set in stone. There are rules to it, but businesses operate differently, and different businesses can legitimately account things differently at different times in good faith. And so what I would suggest is that if you're interested in these kind of things, watch this video, of course, and then, look at some other conference calls. Just go listen to some, or if there are any companies that you have a lot of money invested in or anything, view their conference calls every quarter, and over time you will learn what they're talking about. So what I'm going to try to do today is give you a crash course in what the heck is going on in this quarterly report, in some of the questions they answer, in some of the financial metrics, what it means, what we might infer, what it means for Magic, etc. And so what they will release is several products. They will have a prepared statement, which is what I have on screen now. We're going to go through that first. Then they will have essentially a PowerPoint slide deck that is a bunch of real nice looking slides that just gives good visual plots of a lot of the financial data. And then they will have the actual numbers, the financial data itself. And those are a little more academic. I think they're useful. I'm going to go through some of that with you. And then they will have an actual conference call. The way the conference call goes is they start by reading this prepared statement. And then when they're done with this prepared statement, they will allow typically hand-chosen analysts from investment firms and hedge funds and things to ask a limited number of questions. And I listened to that this morning. There were a couple of things that were kind of interesting. I'm not going to replay the audio from that here. There were only a couple of things that were interesting, and I will talk to those when I get to parts of the prepared statements or the financial data where those are interesting. Okay, so first the investor relations person talks and says, basically, here's a whole bunch of guidelines, legal boilerplate stuff that says, hey, we don't actually know what the future holds, and these are our best guesses, and more data can be found elsewhere. Then the CEO comes on, and he does some pleasantries, and he starts talking about the results. And remember, these are all prepared statements. And so this is typically released a couple hours before the actual conference call happens, so that those analysts who are invited to ask questions live can look over this and prepare more relevant questions in those last couple of hours before the call. So he's going to go over some high-level stuff, and I've just gone through this. I've previewed it, and I've highlighted some things that I want to focus on. So direct business comprised of Magic Arena, D&D Beyond, Hasbro Pulse, Magic Secret Lair was up 15% in 2022. So, that's real interesting. And Secret Lair, of course, part of the direct business where WotC sells directly to you. Arguably, Amazon should be considered direct or almost direct business. They kind of gloss that over and pretend that it's not. But sales from those kind of products were up 15% in 2022. And, these are the highest margin products, stuff like D&D Beyond, where the marginal cost of servicing one more customer is basically zero because it's all software. It's all an internet service. And so this is the kind of stuff we should expect to see them focus on more and more as time goes on. We celebrated our first billion-dollar brand, Magic the Gathering, a huge milestone, not just for Hasbro, but the thousands of hobby stores, our most important and fastest growing channel for the brand. I found this kind of ironic because nearly every decision WotC makes seems to be intended to destroy local game stores. It's very hard to convince me that they consider hobby stores to be their most important and fastest growing channel for the brand. I think fastest growing channel for the brand is direct. it's stuff like D&D Beyond and Secret Lair and things like those. Now the sizes are small, so they're fastest growing on a percentage basis, not an absolute cash basis. But, this is the kind of stuff you'll see in conference calls that just kind of rings hollow, especially once you're familiar with the company, you're familiar with their products. Maybe by the time you become familiar with their actual board of directors and how they conduct the calls, how they answer questions or don't answer questions, and you start to read things like this and you say, well, I know that Hasbro doesn't really consider hobby stores to be the most important thing, especially on the Magic side, on the WotC side of the business. They make a lot of decisions that downright hurt card stores. So this one's great. We were too aggressive in some of our pricing assumptions, notably our 30th anniversary edition of Magic, and pulled back on available supply, impacting Q4's results. So, some of the numbers in Q4 were impacted, and essentially what had happened is they had guided at the Q3 conference call. They had told everybody, look, we're expecting a great Q4 because we're going to print these $1,000 boxes of 60 fake Magic cards, and these idiots are going to eat them up. And it turned out there weren't enough idiots to eat up Magic 30. And so they barely sold any. I mean, I've seen the various analyses on how many they may have sold, and it's pretty dismal in terms of what we suspect they wanted to sell compared to what they did sell. And so what he's doing here is kind of priming everybody and saying, hey, look, Magic 30, it was a bust of a product. It just sold dismally compared to what we wanted. So yeah, be ready because we made some pricing assumptions that were too aggressive and we had to pull back on them. Lastly, on D&D, we misfired on updating our open game license, a key vehicle for creators to share or commercialize their D&D inspired content. Our best practice is to work collaboratively with our community, gather feedback, and build experiences that inspire players and creators alike. It's how we make our games among the best in the industry. We have since course corrected and are delivering a strong outcome for the community and game. And, this is, again, some corporate speak because he knows that analysts are going to ask some questions about the D&D OGL disaster. And, how do you like this typo right here? Yeah. He knows those questions are coming, and in fact, they did come during the question and answer period, and basically he deflected the question. But it's interesting to see we have since course corrected. Well, yeah, they walked back the OGL changes further than where they started from. They gave up more in the end than they had to start with. And they are delivering a strong outcome for the community. It's interesting that he should state that in a present tense, that they are delivering it now. It is yet to be seen what WotC really delivers in the future with respect to D&D licensing. Right now, we have the current OGL situation with the SRD and Creative Commons for the SRD, 5.1 they've called it, something like that. And so we have that kind of current situation that was established a couple weeks ago when WotC surrendered on the entire issue. But again, we've yet to see that they will deliver strong outcome going forward. And again, this comes back to something, I'll probably make a whole nother video about it eventually, but what WotC needs to do with D&D is create good content, because they've essentially painted themselves into a corner now that they've released SRD 5.1 under Creative Commons. They are painted into a corner, and the only way WotC will compete with third-party creators for D&D content is to actually create good content. Imagine that. So he goes into a bunch of their other lines of products and IP tie-ins and movies and entertainment and all these other things. We made progress on both our owned and retail inventory in the fourth quarter, but have more work to do. The teams are focused on clearing inventory. And of course, something that a company like Hasbro has to always keep track of is how is inventory backing up on the retailer shelves? And remember, when we talk about all this stuff with Hasbro, Hasbro is not just Magic the Gathering, right? It's Nerf and Play-Doh and all kinds of toy brands and Transformers and just gobs and gobs of different lines and brands and IPs and everything else. And so when they're talking about product backing up on shelves and in their own owned inventory, then it means in their warehouses, but it means action figures and board games and Play-Doh and everything. And so we know that's a problem with Magic the Gathering. Distributors in the US are still sitting on Zendikar Rising, a 2020 era set that went out of print 10 months ago, and distributors still have it and haven't been able to get rid of all of it. And WotC, just in the last couple of weeks, has done about a 24-hour period of Zendikar Rising Amazon dumping at $84 for draft boxes. So you know that the inventory of Magic in particular is still pretty badly backed up, and it'll probably stay that way for a while. We ended the year with $513 million in cash. As well as we sell through inventory and drive profit expansion, our cash flow is expected to grow during the year. Now, the reason I highlighted this one is because they ended 2021 with a little over $1 billion of cash, and then they ended 2022 with only about $500 million of cash. And this ties into the previous thing of inventory build. It's that they spent a lot of money having inventory manufactured, but then the market just couldn't take it up. And again, this goes with all of their brands, Nerf and Play-Doh and board games and other action figures and everything else, not just Magic. It's that they have a lot of money tied up in inventory sitting in their own warehouses under their ownership that they need to move out and sell into the market. And so as we sell through the inventory and drive profit expansion, our cash flow is expected to grow. So they're basically trying to reinsure analysts and investors that, hey, we have 500 million fewer dollars in cash today than we did a year ago, but look, we know it's a problem. We're working to fix it. So extending our audiences in Magic with our newest Universes Beyond set based on Tolkien's Lord of the Rings series, Tales of Middle-earth. And, I continue to be pretty bearish on Universes Beyond. If you think Magic the Gathering, The Simpsons is part of Magic the Gathering, that's great. Enjoy that. Who cares? But in terms of its ability to do anything beyond juice some numbers in the short term, I'm very bearish. People who are Lord of the Rings fans, they might come over, very likely come over, and yeah, they'll buy, say, a case of Lord of the Rings Commander decks, and they'll put it up on their Tolkien shrine in their bedroom, or they'll put it in a box, or they'll open it up and they'll look at them and they'll think, this is neat, I wish I knew how to play Magic, and then they'll put it back in the box and they won't care anymore. And I am very negative on the ability of Universes Beyond to create long-term revenue, for it to create new players, to bring in people who are not already or in the past have been Magic players. I just don't think it's going to happen much. Now, Universes Beyond has a very good opportunity to create that juice of short-term revenue. And the way it does that is that if you are a lifelong Transformers fan and you see Transformers Commander deck case and it's $1,000, you don't know what it should cost. You don't have a good idea of what the value should be that you're getting. You just know you love Transformers and, hey, these are cool shiny cards with neat pictures of Transformers on them, and it's a neat thing you want to have, and so you're willing to pay the high cost. And that's why things like the Warhammer 40K decks were sold at premium price, because they knew that there were tons of Warhammer players who are already heavily invested in that game. I mean, they have expendable income to play Warhammer 40K, and they know that, hey, we'll make this collector series of the decks that was like $600 or $800 or $1,000, and we'll make the regular series of the decks and it was $200 or $300, something like that. And we know those people will pay it, and so they get all that high margin revenue off of selling those products to those people, and almost none of those people will ever come back and buy another Magic product again. So in the short term, it's great, but in the long term, it's just kind of dead. I just don't see that, again, as the kind of comical example that doesn't exist yet, but I promise it's coming eventually. Magic the Gathering, The Simpsons. Yeah, some people would buy it just for the lulz, but in terms of creating new Magic players, no. Reaching all new global audience scale for D&D with our new blockbuster movie, Dungeons & Dragons Honor Among Thieves, and AAA video game Baldur's Gate 3. Now, this is the same thing. I think the The movie will probably be bad, like most movies are. Movie theaters are a dying industry. Hopefully it goes straight to streaming, so somebody will see it. But it's not going to create new D&D players. The kind of people who want to play D&D are a particular type of people, and simply putting out a bad movie is not going to lure a bunch of new players into D&D. And likewise, Baldur's Gate video game. Yeah, I played original Baldur's Gate, in 2000 or 99, whenever it came out. And yeah, it was great. I'm sure this game will be great, and I'm sure it will create nearly zero new long-term Dungeons and Dragons players. So you can try to turn these IPs into different types of assets in terms of making movies out of them, making video games out of them. But in terms of coming back to the core product, D&D, Magic the Gathering, I don't see any payoff in these things. I just don't think it's ever going to work out. So we'll go down here. And now the CFO, the Chief Financial Officer, will talk for a bit. And again, these are prepared remarks. They are scripted, run by legal and HR and everyone else. Let me start with the balance sheet and our focus on disciplined cash management. And so this comes back to what I was saying earlier, that yes, they have half as much cash today, $500 million fewer of cash on hand than they did a year ago. And so again, they're going to talk about that to try to reassure everybody that, hey, we know what we're doing. We have a plan. So lower sales resulted in higher inventories than planned. And again, that's the problem. The money was used to buy the inventory from the factories, and then now it's sitting in Hasbro's inventory instead of being sold and returning cash to them. At year end, we had reduced our on-hand inventory levels by $168 million from the third quarter. Okay, so that means that over the course of the fourth quarter, they reduced their inventory by $168 million, but those inventories were still up $125 million from last year. And so what it means is that that inventory peaked in the third quarter and came down a little, but it was still $125 million higher at the end of the year than it was at the beginning. This was driven by last year's revenue timing with early retailer purchases and our softer than planned Q4 sales. And so something they talked about on the question and answer period of the call was that a lot of retailers front-loaded purchases in 2022 into the first and second quarter because basically they were coming off of the supply chain issues of 2021, trying to refill their shelves and give themselves a little buffer against further supply chain problems. And so that's why they saw higher sales in Q1, Q2, and then in Q4, they had lower sales than planned because of inflationary issues, wider macroeconomic problems, things like that. And she briefly mentions the timing of Magic releases in early 23 and the increase in paper stock on hand also contributed to this growth. And what she's talking about is Unfinity was originally planned to be released in April of 22 and had to be pushed later into the year. So then by the time it was released, it was in a more crowded part of the schedule. The same with Warhammer 40K. It was originally scheduled for August of 22. It got pushed to October also. And so that's why you had this huge glutted release schedule at the end of 22. And basically that made inventory pile up because the consumer just did not have enough space in their wallet for all of this product. And then the timing of the releases in 23 and the increase in paper stock contributed to growth. So what struck me as really interesting on this is WotC owns the paper stock and gives it to the printers. That was really a surprise to me. I would not have expected that, but I guess they can control the quality of the paper a little better. And did we have anything else in these remarks? Looking at our segments. Okay, so a segment means the way the business is divided up. And when you have large companies like this, they'll often divide their business into segments that kind of try to group the products together in some kind of logical way. And so at Hasbro, the segments have things like entertainment, which are movies and TV shows and stuff like that. And then you have Wizards of the Coast as a segment. And then you have things like action figures and physical toys and stuff as a different segment. So that's what they mean by segments. Wizards of the Coast and digital gaming, which is one of their segments, it combines these two. Revenues increased 5% in constant currency. Tabletop revenues were up 12% behind strong Magic the Gathering releases. Digital declined 23%. So what it means is that Wizards and digital all combined was up 5%. And if you take that down into components, tabletop Magic the Gathering, or tabletop as they call it, which I suspect includes sales of things like D&D books, since that would be under Wizards, those were up 12%, mostly on the back of strong Magic the Gathering sales. And the digital component of Wizards and digital was down 23%. So you can infer from that that the digital component is a much smaller part of that Wizards and digital pie, so that it can drop 23%, tabletop can be up 12%, and in total, it's up 5%. Magic, D&D, and digital remain investment priorities for Hasbro. Yes, I'm sure. I mean, this is another one of those kind of disingenuous statements where it's like, if you really wanted to invest in it, like, what you would do is grow the player base. And that's not really what they're aiming to do. There were even some questions on the conference call that touched on the idea of growing the player base or releasing more products. And the answer did not focus on growing the player base, to put it that way. Adjusted operating profit was $538 million, down 2%, driven primarily by higher product costs, increased royalties due to Magic Universes Beyond, and increased product development. So, when they do those Universes Beyond crossovers, they have to pay IP costs for things like Warhammer 40K IP, and for other IP tie-ins like Stranger Things and Lord of the Rings, and eventually The Simpsons. Universes Beyond products, we expect adjusted operating profit margin in the high 30% range. And again, this goes back to the idea that they know they can kind of charge what they want for those because they're not really made for Magic players who understand the value of Magic cards. They're made for fans of those IPs who are coming in and just buying this one thing and then never coming back to Magic again. And so they are much more price insensitive. And that's why WotC can get higher margin out of those products. Let me see. Okay, so I didn't have anything else in there. So I'm going to switch over to the next thing. Okay, and now we're going to get into some more of the kind of nitty-gritty of the numbers. This is an article that was posted up on Seeking Alpha this morning, and it goes over some of the same kind of comments made by Chris Cox, and I'm going to skip all of those, but we're going to look at some actual numbers, and I'm going to explain how to read these and what they mean and all of these things. So when you have your fourth quarter results, they will present fourth quarter of this past year, 2022, and they'll present it against the fourth quarter of the previous year. But then they'll also present full year of 22 against full year of 21. So you can see on the basis of the entire year, how did things pan out. And so for the entirety of Hasbro, and again, this is Magic plus everything else at WotC plus everything else Hasbro does. So net revenues, and these are in millions of dollars, so $1.6 billion. And that was just in the quarter. And so you can see in the quarter that was down 17% from Q4 of 2021. That's how you read this. And so over the entire fiscal year, for the entire company, the revenues were $5.8 billion, down from $6.4 billion. So you can see a decent decline in revenue, operating profit. And this is after you have basically created your product and sold it. The money that is left is the operating profit. And so they lost in Q4 $126 million. For the whole year, they had a profit of $400 million. And then adjusted gets into these issues with accounting where, the accounting rules can legitimately be different for different businesses for the same thing that is going on. And it just has to do with what is your reasoning for saying that the accounting should work this way. And there are guidelines. There's generally accepted accounting principles known as GAAP, and those will help. But sometimes you have to go non-GAAP because GAAP doesn't really fit what you're doing with your business very well. And so companies will make adjustments. And then later they will explain why they made those adjustments, why they think they're legitimate and in good faith. So then the net earnings, and this is after you have made and sold your product, but then you've paid for everything else in your business. So all your other things like upcoming R&D, if you're in a business where R&D is not attributed to every product you sell, if R&D is a separate expense after operating expenses. In things like car manufacturing, R&D is applied to every car that's sold. So the R&D cost is spread over every one of the cars that's eventually sold. So R&D would look different in those businesses. And so this is the bottom line. When we say top line and bottom line, net revenue is the top line number, and net earnings down here, this is your actual final profit or loss. That's the bottom line number. And for the year, for the entirety of Hasbro, $130 million loss, or this is for the fourth quarter, sorry. For the whole year, a mere $200 million gain. And so then they'll have the adjusted with various, again, accounting adjustments on it, and good old EBITDA. EBITDA is earnings before interest, taxation, depreciation, and amortization. And basically, EBITDA is kind of a good way to lie with your accounting and with your reporting. A lot of businesses will report EBITDA, and for most businesses, you should ignore it. The reason being that if I take my earnings and I take them before I account for interest and taxes and depreciation, there we go, and amortization, what am I really telling you? I've basically made like a fairy tale story. And it's like, if I could manage my personal finances if only I didn't have a mortgage and healthcare and food and gasoline and a car note. And you would look at me and you say, Craig, you're nuts. Like, that means you can't manage your finances. And it's kind of the same way with EBITDA. And so there are times when businesses can report EBITDA and it's meaningful. And an example of that would be, let's say you have a very fast growing business that's still early in its life. It's some kind of, wannabe tech company that's scaling up to size. And it has this business model where as soon as it can, reach 100 million customers, then it'll be a fully grown big boy business. So let's say Amazon through like the early 2000s or so. So from 1993 when Amazon started until sometime in the mid 2000s, you could have taken EBITDA numbers for Amazon and they would have been good numbers because Amazon was not fully grown into its real big boy business model at that time. But when you have a company like Hasbro and WotC, they're fully grown. The reason they have huge interest expenses is because they've taken on tons of debt through some bad choices, some bad circumstances, etc. And so EBITDA numbers for a company like Hasbro are kind of a distraction. So all companies like to report them because obviously if you can pretend that your earnings would have been higher if only I didn't have to pay all these other bills, then yeah, that will make your earnings look higher. So just always be careful when someone tries to sell you EBITDA numbers. You need to understand when they are useful and when they are not. Right here, they get into this explanation of why their earnings were impacted. They talk about things like pulling out of various deals and impairment charges for those things. And then also $64 million and $90 million for the fourth quarter and full year related to severance packages. So these were job cuts, things like that. In the U.S., we have the WARN Act, W-A-R-N, WARN. And it basically says if you are going to lay off more than a certain amount of your workforce, you have to either give them 2 weeks notice, which creates this huge group of people who know they're out the door in 2 weeks, but they have 2 weeks to sabotage everything, or you can lay them all off today, and you have to give them 2 weeks of pay as severance. And so that's what typically these kind of severance charges are related to. It's satisfying the WARN Act. And, contrary to like the popular belief, not every company is evil. And so companies do typically give you some kind of severance when you get laid off because they're not all just terrible and evil. Losses related to entertainment segment. Again, WotC wants to have a streaming service, and I think that's a dead end. Most streaming services are eventually going to be unprofitable and either have to shut down or merge or something. The old days of Netflix and Prime dominating streaming and being successful at it are over, because after the pandemic in 2020, everyone locked at home watching TV all the time. Everybody started a streaming service, and the market cannot support them. You cannot chop up all the content into that small of packages and put a price tag on each one and expect all of them to survive. And so they go on. Magic the Gathering had a record year, exceeded $1 billion in revenue on the back of strong growth in tabletop gaming. Each tentpole set released through the first 3 quarters crossed $100 million in revenue. They never tell what a tentpole set is. I don't know if that's just another way of saying standard, because it would seem to me that DM22 was the tentpole of the year. It held up everything. So I'm not really sure. I'm sure DM22 sold over $100 million in revenue. And Brothers War, released in the 4th quarter, is on track to keep that up and eventually be at over 100 million revenue. This is something I talked about in one of my sales data videos recently, that basically Kamigawa was the first set where they said, hey, we got 100 million in revenue. And then it looked like from the sales data scraped off of TCG Player that every standard set since then had probably achieved that too. And here they are confirming it. Warhammer 40K Commander decks were reprinted 3 times to meet the demand, and Dominaria Remastered, released in January, was supported by initial shipments in the 4th quarter. So what they're doing is just basically saying, hey, even though the set came out in January, we sold a lot of it in the 4th quarter of 22 to get it into the distribution network. And so the net revenues, again, this is top line revenues, Q4 of 22, $263 million, 40% over the Q4 of 21. And for the entire year, $1,065 million, a 7% increase. And this goes back to something that I talk about a little bit on those data videos, which is if you're hoping WotC is going to change course based on people voting with their wallets, well, no, people are not voting with their wallets. WotC is going to continue to release something nearly every month, cram way too many sets into the year, too many products, too high print runs, because right now they are financially getting rewarded for it. Okay, and so here we get into specific segment performances where Wizards of the Coast and Digital is broken out from other things like toys and board games and their movie and TV show lineups and things like that. So again, for 4th quarter of 22 over 4th quarter of 21, the top line revenues of Magic grew 22%. So just comparing those 2 quarters between the 2 years, the operating profit was up, 25%. And then they made no adjustments to that operating profit for accounting issues. So again, if their profit was up 25%, they are not getting any signal that what they're doing is bad. They're getting a signal that what they're doing is exactly right, and they just need to keep doing it harder. And so then they go and they break these out. Again, these are Q4s, Wizards of the Coast and Digital, but EBITDA. So, if you kind of pretend that a lot of real expenses of actual real life don't exist, then here are the great numbers you can manufacture. Again, don't pay too much attention to EBITDA on a company like Hasbro. So here they do the same thing, but it's for the entire year. So Wizards of the Coast and Digital for the entire year, top line revenue, $1.3 billion, a little bit up by 3% over the previous year. And the total operating profit, $538. So it was actually down just a tiny bit. And they'll go into why this is in a little bit. They've got some bullet points in here, pointing some things out for WotC and digital gaming. So segment revenues increased 3%. Revenues increased 5%, excluding a negative $28 million impact of foreign exchange. And so what this means is that when they sell products in other countries in different currencies, they eventually have to convert those currencies back to US dollars. Typically, some businesses will just hold them in foreign currencies for periods of time, but basically it means that when they got to finally convert that foreign currency back to US dollars so they could bring it back to the US, it was worth a different amount. And so that's when a company talks about an impact or an impairment from foreign exchange, that's what they mean. And some companies will buy hedges against foreign exchange issues. And so essentially they enter into an option spread that protects them against swings in foreign currency prices relative to US dollars. Apparently, WOTC is not doing that. Some companies do it, some don't. It's not really a sign that management is smart or stupid. It just has to do with volatility of the business, how much of your business is in foreign currencies, and how volatile you expect the foreign currency market to be in the near future. And so there will be times when companies will engage in that type of foreign exchange hedging on the short term, but maybe on the long term, they don't do it. Sometimes they'll turn it on, they'll turn it off, things like that. Tabletop gaming revenue, meaning physical Magic cards, increased 12%, more than offsetting the 23% decline in digital revenue due to fewer new digital gaming releases in 22 versus 21. So apparently they had some digital gaming releases in 21 that juiced the numbers way back then. They did not have as many new digital gaming releases in 22, so you would expect that digital gaming revenue to go down, which it did, 23%, but because it was such a small portion of the Wizards of the Coast pie, then the 12% increase in physical Magic cards, and I suspect this includes D&D books also, and figures, and all the rest of the things, the increase by 12% overcame it. Operating profit of $540 million was down 2% and reflects higher product costs, royalties due to Universes Beyond growth, and product development. Yeah, product development is one of those ones I wanted to talk about, and I've touched on this before in other videos, typically my TCG player sales data videos. It's that if they're going to release 7 or 8 or 10 flagship expansions, full-size expansions every year, the product development costs go through the roof. Those costs are static with the number of expansions that you release. If you release 10 expansions, you pay for 10. And so that's why I'm an advocate for them releasing fewer expansions. They would have smaller product development costs. And they're talking about the reason that their actual operating profit was down was because partially product development costs. Now, royalties due to Universes Beyond, yeah, that's going to be an issue, but again, these are high margin products, so it's still a good deal for them to enter into those IP licensing agreements and create the products, bring those one-time buyers over to overpay for some Commander decks, and then just let them go on and never come back. That's probably works pretty well for them. Full year 23, we expect mid-single digit revenue growth. And this is the kind of language that you will always get on conference calls. They won't say, we expect somewhere between 4 and 7% growth. Instead, they'll say the much more nebulous, we expect mid-single digit revenue growth. Operating profit margin is expected to be in the high 30% range as we continue to build Universes Beyond and, again, get more of those sucker purchases coming in and invest for long-term growth in these valuable brands. So this section is interesting capital priorities and dividend. During the fourth quarter, Hasbro paid $97 million in cash dividends to shareholders. For the full year, they paid $385 million in dividends, and the next dividend will be on May 15th. So I guess they've probably already paid one in the first quarter here, or maybe in early February. Given the progress made towards reducing debt, the company repurchased 1.4 million shares of Hasbro common stock at a total price of $125 million. Now, if you do the math on that and you take $125 million and you divide it by 1.4 million shares, you get about $89 a share, which over the course of purchasing those shares in 2022 compared to today, that's a pretty bad price because the stock price is $56 today. And so people will often judge companies and say, well, that was dumb. Why did they buy those shares at $89 a share if the price is $56 today? Well, because they didn't have a time machine, because they didn't think their decisions would be so disastrous to the stock price at the time that they repurchased those shares. And, more broadly speaking, share repurchases are really a mixed thing. They get kind of a bad reputation in investment media. But there are times, definitely, when companies repurchasing shares is a really stupid thing to do. But there are times where it's very, very smart. And I'll quickly give two examples. One is that in the US, there's a gun manufacturer named Ruger. And basically, financially, they are a very, very, very well-run company. They have very little or no debt. They pay a dividend that is not just a static blind dividend that slowly marches up over time. Instead of it's a dividend that's based on quarterly profits. So if they don't make any profit this quarter, you don't get a dividend. And they reinvest heavily in the company. They underwrite their own insurance for nearly everything so that they're not paying other underwriters. Just financially, they have everything together as well as a company ever could. And a few years ago, probably right after a US election, because that's what happens, being a gun company, their stock went down like 40% or something. And basically, the board of directors said, that's too low. We know how this company runs. We know what the future probably holds. We think we're in a good financial position. We think the market is acting irrationally. So it went out and it spent like $100 million repurchasing its own shares of stock because it said the stock is too cheap. We're going to go buy it up if everybody else wants to panic sell. So that's the kind of situation where it's really smart to repurchase your own stock. A second example was, I believe it was the alcohol company, Brown-Forman. And a few years ago, they were sitting on a bunch of money. They had a dividend of something like, 4.5%. And basically, if you don't know, the alcohol industry in the world is highly centralized. There are 3 or 4. There's like Ricard, Pinot, or I forget the exact name. There's Diageo, and there's Brown-Forman, and then there's InBev, is it Anheuser-Busch InBev? So between those 4, they control, like 85% of all the alcohol produced in the world, So the whole industry is just insanely centralized. And so a few years ago, they were looking for what to do with all this money they had on hand. And of course, when the industry is already greatly centralized, they really can't just go out and buy up small startup distilleries and breweries and wineries and grow their business. There may not be any good opportunities for that out there, and they can't really merge with anyone else because essentially getting it past SEC approval is going to be impossible because of how centralized industry already is. And so what they did is they said, why don't we just repurchase shares? Because if our dividend rate is 4.5%, then if we repurchase shares, we're getting a 4.5% return on the money spent for those share repurchases in perpetuity because we're no longer paying dividends on those shares because we've retired those shares. And so in the business sense of how can we take this money and use it to generate profit or income or cash flow or any of those in the future, the best way to deploy the money was to just repurchase their own shares and retire them so they didn't pay dividends on them anymore. And so those are 2 examples where, share repurchases can be really smart for a company. And now Hasbro, currently with its share price down in the 50s, it's paying something like 4% dividend. In general, probably it was not worth rebuying shares at $100, but we say that in retrospect. Today, is it worth it? Oh yeah, I think today's a good time for Hasbro to rebuy its own shares when they're down in the 50s and the dividend's 4%, and maybe they've got $500 million of cash on hand, but they've already authorized $241 million remaining to buy shares with. And to explain that quickly, companies will warn the market and they will say, hey, we're planning in this fiscal year to repurchase maybe up to $300 million of our own stock, just so the market is not shocked when they actually go out and do it. So the market has some knowledge beforehand that, hey, we might expect $300 million of float to disappear over the course of the year. The company continues to target debt to EBITDA of 2 to 2.5 times. And so what they mean there is they want to reduce their debt until it's only 2 or 2.5 times their EBITDA. And again, EBITDA is kind of this silly manufactured number. So the ratio to their real earnings would still be much greater than 2 to 2.5 times. So, keep those things in mind when you're looking at those numbers and you're thinking, oh, a debt load of 2 to 2.5 times earning is fine for a big company. Well, it's not fine if it's the ratio of debt to EBITDA, not debt to earnings. They expect to make progress on that target this year, so essentially they intend to pay down some of their existing debt, and they'll use proceeds from selling film and TV assets that they don't think they can profit on, but they'll sell them to someone else, and they'll use that money to pay down debt. and they are committed to maintaining their investment grade rating. Have you ever seen a company say, we're not committed to our investment rating? Because that essentially determines what interest rate they pay on debt. That, like, it's a real thing that's happening. And so I'll show you some of these factors that might cause such a difference between what we expect to happen and what does happen in the future, include but are not limited to. So basically, our ability to execute on our prime corporate strategy. Yeah, if you can't execute on your prime corporate strategy for whatever reason, your results are probably not going to turn out how you expected. You see, it's kind of a statement, but sometimes people will see this and they'll think, oh my goodness, Hasbro isn't executing on their prime corporate strategy. So if they can't build and ship products in a timely, cost-effective, and profitable basis, how stupid is that statement? But it's the kind of CYA lawyer stuff you have to put into these publications, that if we can't do business profitably, our ability to profitably run a business might be impacted. Yeah, If we can't compete in global play and entertainment industry, yeah, it's going to be hard for a game company if they can't compete. Our ability to evolve and transform our business. Yeah, you have to be nimble in today's economy. So all of this stuff just goes through that. And it's just, don't get scared over anything you read in this. It's basically so that in the future, if a bunch of activist investors get together and want to sue the company, sue the board of directors for mismanagement, the board of directors can come back and say, look, we put a risk that the PRC might confiscate all of our production and all of our IP and steal everything we own in China. We put that risk in the statement. You knew it was a risk and you kept investing with us. And hopefully the judge would throw out the lawsuit. And so that's all this is. I'll let you read those on your own time. And then again, right afterwards, they have this statement about non-GAAP, and it's another one of those things you should read once in your life so you kind of understand, yeah, GAAP is nice, generally accepted accounting principles, but it's not always reality. It's not always the correct way for every business to account everything. And that's why businesses will give GAAP and non-GAAP data. And so I know there are a lot of people who are kind of naive about investing, and they think anything non-GAAP is just fraud. It's trying to cheat somehow, and that's just not the case. So read that once in your life, and then we'll get into more of these tables. And so here is the condensed consolidated balance sheet. And so the balance sheet for a company is basically a very high level list of all the assets the company owns. So we can see these are taken at the end of Hasbro's financial year, which is December 25th. And in 2021, it was December 26th. So the snapshot on that day, the company had in cash $513 million at the end of 22, compared to a little over $1 billion in the end of 21. And that's what people kept talking about. Yes, we know our cash is down by 50%. We have a plan. We understand it's a problem. Accounts receivable, this is what people owe them that they have not collected yet. And so, maybe if a distributor buys a couple $1 million of product at a time and they're on 90-day terms, then, well, this is the last 90 days of sales that just haven't been paid by the distributors. That would kind of be an example of it. Inventory on hand, that's considered an asset because you will sell it in the future for money. And so you can see that inventory growth over the course of the last year, that it came up by, nearly 30%. Prepaid expenses. So this is if they have already paid for something and they have not realized the benefit from paying for it yet. So they will realize the benefit in the future. So that's accounted as an asset. So then the total current asset should just be the sum of these. Property, plant, and equipment. So say WotC owns its office building in, is it Seattle, I think? And unsurprisingly, the amount of property, plant, and equipment that a company like Hasbro has does not go up much over time. I think they contract most of their toy production to factories in China, and so they don't own that property, plant, and equipment. If they ever got into the actual hardcore manufacturing themselves, then they would, and this number would be expected to swing a lot year to year. Goodwill is a great one. It's entirely intangible, meaning there are not boxes of goodwill in a WotC warehouse somewhere that you can go measure and audit. Instead, it is a made up number that is essentially it's the value of customer appreciation that is acquired when you purchase a company. And it's kind of difficult to understand. The number is entirely made up by Hasbro. I do not know the extent to which you can try to audit it because it's an intangible. So you have to be careful with this one. Saying they have $3.5 billion of goodwill, I don't know. I mean, as long as they don't change that number much year to year, I wouldn't feel too bad about it. But if you're seeing wild swings in a company's goodwill report, then that's definitely a red flag to look out for. Other intangible assets, this will be things like intellectual property, maybe patents, trademarks, stuff like that. So if they have maybe some internal software they've developed for some process in their business, they might say that's an asset, because if someone were to come to try and acquire Hasbro outright, then that's an asset that would need to be accounted for and sold to the new company with some value attached to it. And then other, and somewhere they would break down what might be on that list, and you total everything up. And so that's basically $9.3 billion is what they say all the assets of Hasbro are worth. And so then we go right on to the liabilities. What are the liabilities the company has? And here they get broken down into short-term and long-term. So short-term borrowing, this will typically be things like revolving lines of credit that companies use, where they just need a huge chunk of cash right now, and they don't have enough cash on hand for that, or they don't have it in the right place. Maybe it's in the wrong currency, it's sitting in the wrong country, something like that. They need a chunk of cash, so they have a revolving line of credit with a bank that says, yeah, you'll pay typically like LIBOR plus 3% or prime rate plus 3% or something like that. And you can get $142.4 million to just go do something real quickly. So, Hasbro might use that to go pay a bunch of factories in China to make toys. They'll ship the toys over to the US, and Hasbro will immediately move them out to the distribution system and pretty quickly get paid by the distributors, and then use that money to pay off the revolving line of credit. And so that's an example of short-term borrowings. The current portion of long-term debt, that's long-term borrowings that are due within the next year. Accounts payable and accrued liabilities. So this is money that Hasbro owes to other people. So again, money it might owe to factories in China, to advertising agencies, to movie studios it is partnering with to produce films, things like that. So the current total liabilities will be the sum of these three. And then the long-term debt, these are things that are financed out on more than a year timetable. So things like bonds and convertibles and all these other debt instruments that large companies might take on. Other liabilities, there'll be an explanation somewhere. And so total liabilities will be all this stuff added up. The shareholder equity is the difference between the liabilities and the assets. And so if you take this $9.3 billion in assets and you subtract this $6.4 billion in liabilities, you get $2.8 billion, which is the net assets minus liabilities. So that's what the shareholder equity is worth. Another interesting table hiding down here is Wizards of the Coast and digital revenues by category, so we can kind of get an idea of the split between digital and paper on Magic. And licensed gaming is kind of going to muddy this up, but hopefully that shouldn't be too big. I suspect that's things like licensing out Magic IPs to other things. Like I know Ultra Pro will produce Magic themed deck boxes and card sleeves and stuff like that. So I wonder if that's where that's lumped in. I can't imagine those are big numbers coming in, so you might just round them to zero is the best you can do, and then take the ratio between these two numbers and say, hey, that's the split between tabletop paper Magic and digital, except since this is Wizards, this also has D&D Beyond is on here, and D&D paper books are here, So, you can try to make a model starting here. This is probably not the worst place to try to make a model that breaks out that ratio. And this is the year-end revenues for just the Wizards of the Coast and digital. Again, $1.3 billion. And this will be Magic, D&D, all the things at Wizards of the Coast and their digital products also. Operating profit. So this is after you pay the money to have the things manufactured, you pay the printers, and you pay to actually get it to where it's being sold. So the distribution network. So, you've paid storage and transportation costs and things like that. And even, say, your salespeople who work with the distributors to sell it from WotC to the distribution network, pay for them gets lumped into here, and what you're left with is the operating profit. So the operating margin is a very nice 40.6%, pretty amazing. And then, when you squint and pretend and act like taxes and interest aren't real things, then you could up that from 538 to 549 million for the year. And so this is kind of a weird chart. This is the accounting adjustment, and then this is after that adjustment, and then there's 3 more columns, but Seeking Alpha is kind of dumb and cuts them off, and it has all kinds of formatting errors still this many years after it's been a live website. But these would be the numbers for the previous year. So these numbers here would compare to these on a like-for-like basis. So you can see the margin was 42.5% last year, and in this year it was only 40.6%. So the margins went down, and again, they talked about that with licensing fees for D&D Beyond and the cost of paper and building it, transportation costs and all those other things. So the reason for the margins to shrink, but the top line increased by $40 million, and the bottom line decreased by a very slight amount, only about $10 million. Much of the rest of this centers around reconciliation of non-GAAP financial measures and explanations for why they account things non-GAAP the way they do, and how they kind of show that it's a good faith effort of trying to show you exactly what their business is doing. So again, don't get upset when companies report non-GAAP numbers. It doesn't mean there's fraud going on. It doesn't mean they're being shady. It typically just means that GAAP principles do not fit what they're doing in their business, and there is no business for which GAAP is a perfect fit. So there's a lot of this in here, the explanation. I just scrolled and scrolled and scrolled, so go off and look at that on your own if you want. Leave me questions for that, and I will happily try to answer them. Now we're going to move on to one last really interesting thing I saw. And that last interesting thing was this one slide out of the PowerPoint slide deck that they present, and it was cost of sales. I think this is really interesting. And so the cost of the sales is going to be what do you have to pay to get the things manufactured, the toys and the board games and the Magic cards and the D&D books and all the rest of these things. What does it cost to get them manufactured, to get them moved to the distribution network? What does it cost to pay the people who do the manufacturing and who coordinate the logistics of moving the product? And so I thought this was really cool to see this breakdown. And so what you see, and again, this is for the entire company. This is not just for WotC and not just for Magic. So as a percentage of revenue, well, revenue is 100% of revenue, but their gross margin is 64%, which means the cost to get that revenue is 32.6% of the revenue. And then they break it down here. I thought this was really cool. Board, paper, and print, 5.3. Resins for all kinds of toys and action figures and things like that. Electronics for when your Transformers action figure screams Autobots roll out. All other, I'd love to see a breakdown of that. 5.6 for labor. That would be like the workers in the factories. It would be the salespeople and the supplier support and all the other people who work on getting that product from the factory into the distribution network. This probably would not include R&D and development and game testing and those kind of people, graphic artists and all the rest of that. It would not include those. Factory overhead. I thought that was kind of interesting and implies that Hasbro owns at least some of its own factories. maybe that's just a rolled through cost from the owners of the factories in China and wherever else they manufacture. Freight and import costs, tooling, when you need a special type of tooling like molds or things like that, die cutters, all kinds of other things. And then inventory variances. I suspect this means a couple things. It's probably shrinkage due to theft, but it's also probably shrinkage due to producing a product which requires real materials and labor, but then that product not meeting the quality standards and having to be thrown away. So I guess it's things like that. And then also things like, once in a while, your 18-wheeler of G.I. Joe action figures turns over on the highway, spilling them everywhere, and you have to account for that. Or sometimes a pallet of magic cards somehow gets left out in the rain or consumed in a fire or something like that. So I assume that's what all those things are. And for some reason, they put all of these on the left side and total them here, and all these on the right side and total them here. I guess these are physical inputs to the system, and these are physical and non-physical inputs to the system. And so the total cost of the sales was 32%. I thought that's just a really interesting thing to know, to see how does this business work at the operational level. Okay, guys, hopefully that kept you entertained. You learned something. And if you have any questions, leave them down below. I will do my best to answer them and help you learn some more. So if you'd like to see this in the coming quarters, I can do this every quarter. Historically, I've always followed conference calls of companies I worked for and a couple of companies that I invest heavily in. I think you can learn a lot about how business works, about how investment works, about how board of director types think. They are sociopaths, but they're not 100% evil. They are making typically decisions for the long term of a company. It's not entirely just short-term thinking. It's that the short-term thinking is what gets the big headlines and looks really bad. So let me know what you think, guys. Otherwise, like, comment, share, and subscribe. Join me on Final Trade. Thanks a lot.